There's a silent predator in the stock market. It doesn't show up on a balance sheet, and you won't find it in any analyst report. It moves quietly, cloaked in the disguise of success. Its favorite hunting ground is a rising market, a place filled with optimism and easy money. This predator is the character flaw, the hidden defect in the heart of a company's leadership. And when it strikes, it doesn't just cause a stock to dip, it causes it to evaporate, wiping out fortunes, retirements, and the life savings of investors who made one simple, fatal mistake. They looked at the stock chart, but they forgot to look at the person running the company. They saw the price going up, and they ignored the quiet ticking of a time bomb in the executive suite. Warren Buffett, arguably the greatest capital allocator in history, has spent a lifetime fortifying his empire against this exact threat. He knows that the most devastating risks aren't market crashes or economic recessions. They are the self-inflicted wounds caused by dishonest, irrational, or egotistical management. To protect himself, he developed a disarmingly simple yet profoundly powerful mental tool. It's not a complex financial ratio or a secret algorithm. It's a character test. A question he asks himself before deploying a single dollar of his shareholders' capital. He calls it the newspaper test. And the principle is this: only do business with people and companies whose actions you would be proud to see chronicled, in full detail, on the front page of your local newspaper, to be read by your friends, your family, and your neighbors. This isn't about vague morality or corporate platitudes. It is the single most powerful risk management tool an investor can possess. It is a filter designed to prevent the costliest mistake in the market, the seduction of overlooking questionable leadership because the stock price is soaring. We've all felt it. The thrill of a stock that doubles then triples. The feeling that we've found a genius CEO, a visionary who can do no wrong. In that euphoria, we start to make excuses. The accounting looks a little aggressive. Well, they're a growth company. The CEO seems overly promotional. He's just passionate. There are whispers of a toxic corporate culture. They're just disrupting the old guard. We ignore the red flags because acknowledging them would mean admitting the party might soon be over. And so we hold on, blinded by the green numbers on our screen, until the day the music stops. The day the scandal breaks, the SEC investigation is announced, the fraud is revealed. The day the story that was too good to be true is exposed. On that day, the stock doesn't pull back. It collapses. And the investors who ignored the character test are left holding a worthless piece of paper, wondering how it all went so wrong. The financial transformation this one mental model provides is absolute. When you adopt the newspaper test, you fundamentally change your relationship with investing. You cease to be a speculator chasing price movements and become a business partner seeking integrity. You prioritize trustworthiness above trendiness and lasting value above short-term hype. This shift protects you from the sudden, catastrophic losses that plague the unprepared. It aligns your capital with management teams who are not just building a stock price, but are building a durable, lasting enterprise. This is the difference between gambling and investing. It is the foundation of capital preservation and the true engine of long-term wealth. Today, we are going to deconstruct this powerful strategy. We will go far beyond the simple phrase and build a comprehensive, actionable framework around it. We will explore the deep psychological reasons it works, provide a step-by-step blueprint for its application, and examine the financial wreckage left behind when it is ignored. This is not just a lesson in stock analysis. It's a masterclass in executive decision-making and the art of avoiding ruin. This is the story of the final promise every great leader makes to their shareholders, the promise of integrity. Our journey begins with the foundational principle, the bedrock upon which Buffett's entire philosophy is built. This is the understanding that management isn't just one part of the equation, it is the entire operating system. It is the ultimate competitive advantage, the one moat that can never truly be replicated. We're calling this first pillar, the primacy of integrity, management as the ultimate moat. In the world of finance, we are taught to look for moats, durable competitive advantages that protect a company's profits from competitors. These can be strong brands, patent protections, or network effects. But Buffett understood a deeper truth. All of those moats can be breached. A brand can be tarnished. A patent can expire. A network can be disrupted. The only truly enduring moat is a management team with absolute, unshakable integrity and a rational, owner-oriented mindset. Why? Because this is the team that will wisely allocate capital to widen the other moats year after year. They are the guardians of the fortress. A fortress run by knaves, no matter how strong its walls, will eventually be sold off piece by piece from the inside. To understand the weight Buffett places on this principle, we must travel back to 1991. The setting is not the serene headquarters of Berkshire Hathaway in Omaha, but the frantic, high-stakes world of Wall Street. The company is Salomon Brothers, one of the most powerful and aggressive investment banks on the planet. Berkshire was its largest shareholder, with a massive $700 million stake. Salomon was a titan, but it was a titan with a notoriously cutthroat culture, famously captured in the book Liar's Poker. It was a place where traders were encouraged to take immense risks, summarized by their unofficial motto, "Rip the customer's face off." This culture of pushing the envelope, of dancing on the edge of the rules, finally went too far. In August 1991, a bombshell dropped. Paul Moser, a top trader at Salomon, was discovered to have been submitting false bids in U.S. Treasury auctions, a flagrant and illegal attempt to corner the market for government bonds. This wasn't just a minor infraction, it was a direct assault on the integrity of the United States financial system. The scandal exploded. The U.S. Treasury banned Salomon from bidding for government securities, a move that was effectively a death sentence for the firm. The company's stock plummeted, its clients fled. Its credit lines were pulled. Salomon Brothers was on the verge of collapse within a matter of days. In the midst of this five-alarm fire, the board turned to their largest shareholder for help. They asked Warren Buffett to step in as interim CEO to save the firm. Imagine the position he was in. His personal reputation, built over a lifetime of careful, honest dealing, was now on the line. He was about to attach his good name to a company that had just been publicly branded as a cheater. His friends advised him against it. His legacy was at stake. But his capital was also at stake, and he believed that if he could just stabilize the ship, the underlying business was still valuable. He accepted. And what he did next is a masterclass in the primacy of integrity. He flew to New York, and in his first address to the thousands of terrified Salomon employees, he didn't talk about profit targets or trading strategies. He laid down the law on character. He told them, "We're going to have a new philosophy at Salomon. You can lose money for the firm, and I will be understanding. You can make a mistake, and I will be understanding, but lose a shred of reputation for the firm, and I will be ruthless." He then had to go to Washington, D.C. to testify before Congress, to convince them not to deliver the final killing blow to Salomon. Standing before a panel of furious lawmakers, he was asked what he was doing to fix the deep cultural problems at the company. His answer became legendary. He explained that he had instituted a simple rule. He told every employee that when they were considering any action, they should ask themselves if they would be willing to see it reported the next day on the front page of their local newspaper, written by an intelligent but not so friendly reporter, to be read by their spouse, their children, and their friends. If they had any hesitation, he said, they should not do it. He was, in essence, installing the newspaper test as the official corporate governance policy for the entire firm. This wasn't just about avoiding illegal acts. It was about avoiding anything that was even close to the line. He was telling them that the firm's reputation, its pool of trust with the public and with its clients, was its single most valuable asset. It was more valuable than its trading prowess, its capital, or its client list. Because without that reputation, all the others would vanish. Buffett's intervention worked. He saved Salomon Brothers from bankruptcy, not by being the smartest trader, but by being the most credible man in the room. He leveraged his personal integrity to restore the market's trust in the firm. This anecdote isn't just a story about a crisis. It's the living embodiment of his belief. A company is only as strong as the character of its people. And as an investor, if you partner with people of questionable character, you are knowingly accepting the risk of a total and sudden collapse. Because reputation, once lost, is nearly impossible to regain. The power of this approach is rooted in a fundamental concept in economics and behavioral science, the principal-agent problem. This problem describes the inherent conflict of interest that arises when you, the principal, in this case a shareholder or owner, hire an agent, a CEO, and their management team to act on your behalf. How do you ensure that the agent will always act in your best interests, rather than their own? Companies spend billions of dollars trying to solve this. They create complex executive compensation plans, they hire armies of auditors, they install boards of directors. All of these are attempts to align the agent's interests with the principal's. But Buffett realized that these are all imperfect, external solutions to an internal problem. The true, most efficient solution to the principal-agent problem is not a better contract, it's better character. When you invest with a management team that possesses unimpeachable integrity, the conflict of interest largely dissolves. A leader with integrity sees themselves not as an agent for hire, but as a steward of your capital. They instinctively think like an owner because their internal moral compass demands it. They aren't trying to maximize their own bonus this quarter. They are trying to build durable value for the long term because that is what they believe is the right thing to do. This has a profound psychological effect on you, the investor. Trust is a powerful cognitive shortcut. When you deeply trust the people running your companies, it frees up immense mental and emotional energy. You no longer have to spend your nights worrying if the accounting is fraudulent, or if the CEO is about to use company funds to buy a private island. This is a critical component of successful long-term investing. The constant need to verify, to second-guess, and to be suspicious is exhausting. It leads to short-term thinking and portfolio churning. By filtering for integrity first, you are offloading a massive cognitive burden. You are replacing the need for constant vigilance with the confidence of a true partnership. You are betting that the internal compass of your management team is more powerful and more reliable than any external set of rules or regulations. This is the ultimate solution to the principal-agent problem. Don't just try to align interests with contracts. Find people whose interests are already naturally aligned with yours because their character demands it. This is a central tenet of effective wealth management and capital preservation. So how do we translate this powerful idea into a practical, repeatable process? We need an applied mental model, a blueprint for action. Let's call it the stewardship scorecard. Before you even look at a company's price-to-earnings ratio or its revenue growth, you must run its leadership through this qualitative filter. This is the due diligence that 99% of retail investors skip. First, become a student of their communication. Go and read the last 10 years of the company's annual shareholder letters. Do not skim them. Read them carefully. Are they clear, candid, and consistent? Or are they filled with corporate jargon, buzzwords, and excuses? A great manager, like a great partner, tells you the bad news just as clearly as the good news. Look for admissions of mistakes. A CEO who openly discusses their errors and what they learned from them is demonstrating humility and a commitment to transparency. A CEO who only talks about victories is either lying or dangerously overconfident. Warren Buffett's own letters are the gold standard for this. They are models of clarity and honesty. Second, scrutinize the executive compensation structure. This is where the truth is often revealed. Download the company's proxy statement. Is the CEO's bonus tied to short-term metrics like hitting a quarterly earnings per share target? This encourages short-term thinking and potential accounting games. Or is it tied to long-term per share value creation, like growth and return on invested capital over a 5-year period? You want to see management eating their own cooking. Look for high levels of insider ownership. Are they buying stock with their own money on the open market? That is a powerful signal of alignment. Conversely, if they are constantly selling shares while telling you how great the future is, that's a massive red flag. Third, analyze their capital allocation decisions. A CEO has 5 basic choices for deploying profits: reinvest in the business, acquire other companies, pay down debt, issue dividends, or buy back stock. Their track record here is their resume. Have their past acquisitions created value? Or were they ego-driven empire building that destroyed shareholder wealth? Do they buy back stock intelligently when it's undervalued, or do they buy it back at market highs just to prop up the price? A great steward of capital treats your money with the same care and prudence they would treat their own. Creating this stewardship scorecard for every potential investment forces you to put character first. It is the core of a professional stock analysis process. Now let's look at the opposite path, the path walked by the vast majority of market participants. This is the path of the 99%. The common approach is to completely ignore the qualitative and focus entirely on the superficial. The average investor starts their research by looking at a stock chart. If the line goes up and to the right, they get interested. They might look at a few simple metrics like the PE ratio and see if it's lower than its competitors. Then they'll read a few glowing headlines or watch a promotional interview with the CEO on a financial news network. They fall for the charismatic, visionary CEO, the one who promises to change the world, the one who is always selling the dream. This CEO is a master of narrative, but a poor steward of capital. They are what we call the hired gun. Their primary goal is not to build a lasting enterprise. It is to maximize their own compensation package before they move on to the next gig. The hired gun CEO is obsessed with short-term appearances. They will do anything to beat Wall Street's quarterly earnings estimates by a penny. This might mean cutting back on crucial research and development, squeezing suppliers until the relationship breaks, or using every accounting trick in the book to make the numbers look good for a few quarters. They view the company not as a living organism to be nurtured, but as a vehicle for their own enrichment. Investors who partner with this type of leader are setting themselves up for disaster. They are attracted by the illusion of success, the short-term sugar high of a rising stock price fueled by financial engineering. But this success is brittle. It has no foundation. The moment the growth story falters, or the accounting tricks are exposed, the entire edifice comes crashing down. This is the path of chasing hype, and it almost always ends in tears. The 99% are drawn to these stories like moths to a flame, ignoring the clear and present danger posed by a leadership team whose interests are fundamentally misaligned with their own. This is a failure of risk management and the primary reason most investors underperform over the long term. Finally, let's connect this principle of integrity directly to the cold, hard numbers on the financial statements. How does good character manifest on a balance sheet or in an income statement? The connection is direct and quantifiable. First, look at employee turnover. Companies led by trustworthy, respected leaders tend to have much lower employee turnover. This isn't just a feel-good metric. High turnover is incredibly expensive. It costs money to recruit, hire, and train new people. More importantly, it represents a constant drain of institutional knowledge and expertise. A business with a stable, motivated workforce is simply more efficient and innovative. This translates to lower operating costs and higher margins over time. Second, look for a clean and simple balance sheet. Great managers don't need to hide things. You won't find a labyrinth of off-balance sheet entities, special purpose vehicles, or other complex financial structures designed to obscure debt or risk. They present their financials with clarity because they have nothing to hide. This simplicity is a hallmark of integrity, and it dramatically reduces the risk of an Enron-style implosion where the company is revealed to be far weaker than it appeared. Third, and most importantly, is the long-term trend in return on invested capital, or ROIC. This metric measures how efficiently a company is using its money to generate profits. A management team with integrity and a rational, owner-oriented mindset will consistently make intelligent capital allocation decisions. They won't overpay for flashy, ego-driven acquisitions. They will reinvest profits into high-return projects. They will only buy back stock when it makes sense for the remaining shareholders. Over a decade, the result of these thousands of smart, disciplined decisions is a consistently high and rising ROIC. This is the ultimate financial signature of a great management team. It is the mathematical proof that they are not just running a company, but are skillfully compounding your capital. Prioritizing integrity is not a soft skill. It is the most ruthless long-term financial strategy there is. It is the ultimate form of capital preservation and the true engine of portfolio growth. We've established the foundation that management integrity is the ultimate competitive moat. But if it's so important, why do so many smart people get it wrong? This brings us to our second pillar, a deep dive into the psychology of a rising market. We must understand the seduction of the rising stock, how greed blinds us to red flags. There is a powerful narcotic in the world of finance, more addictive than any drug. It is the sight of a stock you own going up day after day. This experience triggers a cascade of powerful chemicals in the brain. It feels like validation. It feels like you're a genius. And in that state of euphoria, your capacity for critical thinking can plummet. The warning signs, the red flags about the company's leadership that might have seemed obvious in a colder moment, suddenly become blurry, easy to dismiss. You are being seduced by the ticker tape, and this seduction is one of the greatest dangers an investor will ever face. It's the moment when the fear of missing out overpowers the fear of losing everything. To fully appreciate the immense psychological pressure to abandon one's principles during a market mania, we need to look at Buffett's own trial by fire, the dot-com bubble of the late 1990s. From 1995 to early 2000, the world went wild for technology and internet stocks. Companies with no profits, no revenues, and in some cases, no finished product, were seeing their stock valuations soar into the billions of dollars. Pets.com, Webvan, GeoCities. These were the darlings of the market, and their CEOs were lauded as visionaries, the architects of a new economy where old rules of valuation no longer applied. During this period, Warren Buffett and Berkshire Hathaway were widely mocked. Their portfolio was filled with old economy stocks like Coca-Cola, Gillette, and the Washington Post. As the Nasdaq Composite Index rocketed up 85% in 1999 alone, Berkshire Hathaway's stock actually fell by 20%. Barron's, a leading financial magazine, ran a cover story in 1999 titled, "What's Wrong, Warren?" The article questioned if the old master had lost his touch, if his value investing principles were now obsolete in this new technological age. Imagine the pressure. Your friends, your colleagues, your neighbors are all getting rich, seemingly overnight, by investing in these hot tech stocks. They're talking about their 10-baggers at cocktail parties. Meanwhile, your own meticulously chosen portfolio is underperforming badly. You are being publicly ridiculed as a dinosaur. Every fiber of your being is screaming at you to join the party, to just buy a little bit of this dot-com magic. This is the moment where character is forged. It's easy to stick to your principles when they are working. It is brutally difficult when they appear to be failing. Buffett and his partner Charlie Munger watched this mania unfold, and they did nothing. They refused to invest in companies they didn't understand, run by management teams whose primary skill was self-promotion, not business operation. They couldn't apply their newspaper test to these companies because their actions were already questionable. They were burning through cash at an alarming rate, making wild, unsubstantiated promises, and cashing in their own stock options as fast as they could. The stock prices were rising, but the underlying businesses were, in many cases, hollow. Buffett was willing to endure the pain of underperformance and the humiliation of public scorn, rather than abandon his core principle of investing only in businesses he understood, run by people he trusted. And then, in March of 2000, the bubble burst. The Nasdaq, which had peaked above 5,000, began a brutal, relentless collapse. Over the next 2 years, it would fall nearly 80%. Those high-flying dot-com darlings were wiped out. Pets.com, which had raised $82 million in an IPO, went bankrupt just 9 months later. Trillions of dollars of speculative wealth vanished. And in the wreckage, Buffett's old economy companies stood strong. Berkshire Hathaway's stock soared. The anecdote isn't about him being a brilliant stock picker who timed the market. It's about him being a brilliant risk manager who refused to be seduced by the rising tide of irrationality. He understood that a rising stock price is not proof of a good business. It is often just proof of a popular delusion. The dot-com bubble is a perfect illustration of two of the most powerful and dangerous cognitive biases that warp our financial decision-making: social proof and confirmation bias. Social proof, or herd mentality, is our deep-seated psychological need to conform. When we see a large group of people doing something, like buying a particular stock, we instinctively assume they must know something we don't. The rising stock price itself becomes the social proof. It creates a feedback loop of greed. The price goes up, which attracts more buyers, which pushes the price even higher, which is seen as even more proof that it's a great investment. This is how bubbles are born. It's an abdication of individual due diligence in favor of collective momentum. The rational part of your brain that might want to investigate the CEO's background or question the company's accounting gets silenced by the much louder, more primal fear of being the only one left on the sidelines while everyone else is getting rich. This is a powerful force that can make even the most intelligent people do incredibly foolish things with their money. Compounding this is confirmation bias. This is our tendency to actively seek out and favor information that confirms our existing beliefs, while simultaneously ignoring or devaluing information that contradicts them. Once we've bought a stock, we are psychologically invested in it being a good decision. If the stock is soaring, this bias goes into overdrive. We will eagerly consume the promotional CEO interviews, the bullish analyst reports, and the positive news articles. These all confirm our genius. But what about the negative information? The reports about insiders selling, the questions about the business model, the critical articles pointing out flaws in corporate governance. Our brain has a defense mechanism. We dismiss this information. We tell ourselves the source is biased, the critics are just haters, or they don't get the new paradigm. We build a comfortable cocoon of confirming evidence around our decision, effectively blinding ourselves to the mounting risks. The rising stock price acts as the ultimate confirmation, a daily dose of validation that allows us to ignore a mountain of red flags about the character and conduct of the management team. These two biases, working in tandem, create a psychological trap that is incredibly difficult to escape. They are the engine of speculative manias and the reason why so many investors get burned when they chase performance without performing due diligence on leadership. To counteract these powerful biases, we need an equally powerful mental model. We need a systematic, unemotional process that forces us to see the red flags, even when we don't want to. Let's call this blueprint the red flag repository. This is a simple but rigorous practice you must adopt for any potential investment, especially one that is already popular and rising quickly. Before you invest, you create a dedicated document or notebook for the company. You divide it into 3 sections. Section 1 is for promotional language. Here, you will log every instance of the CEO or management using hype, buzzwords, or exaggerated promises. Are they constantly talking about disruption, revolutionizing, or changing the world, but are vague on the actual economics of the business? Do they compare their company to wildly successful giants like Amazon or Apple without justification? Overly promotional language is often a substitute for actual business substance. It's a key red flag that the leadership is more focused on selling the stock than on running the business. Section 2 is for financial obfuscation. This is where you track any signs of questionable accounting or a lack of transparency. Have they recently changed auditors? Do they frequently use pro forma or adjusted earnings numbers that conveniently exclude a lot of real costs? Is their balance sheet a mess of complex structures you can't understand? A key Buffett and Munger principle is to stay within your circle of competence. If you cannot understand how a company makes money and presents its finances after a reasonable effort, you must assume something is being hidden. This is a critical part of risk management. Complexity is often used to hide a lack of substance. Section 3 is for misalignment of incentives. Here you track anything related to executive compensation and insider activity. Is the CEO's pay package astronomical and not tied to long-term performance? Are insiders, including the CEO and other top executives, consistently selling large blocks of their stock? This is perhaps the most telling signal of all. If the people who know the most about the company's future prospects are quietly heading for the exits while telling the public to buy, you are likely being set up to be the bag holder. The rule of the red flag repository is simple: 3 significant red flags and you walk away. No matter how compelling the story is, no matter how much the stock is going up, this system acts as a circuit breaker. It forces you to confront the negative evidence that your confirmation bias wants you to ignore. It is a disciplined, unemotional approach to due diligence that can save you from the seductive allure of a rising stock price that is detached from reality. The antithesis of this disciplined approach is what we call the story stock investor. This is the path taken by the 99% who get swept up in market manias. The story stock investor doesn't fall in love with a business. They fall in love with a narrative. They are captivated by a charismatic CEO with a grand vision and a compelling story. The story is so good, so emotionally resonant, that it replaces the need for actual financial analysis. Think of the story of WeWork and its founder, Adam Neumann. The story was incredible. It wasn't a real estate company. It was a global community, a movement to elevate the world's consciousness. The story was so powerful that it attracted billions of dollars in investment at a valuation that defied all logic. But while investors were buying the story, the red flags of poor corporate governance were piling up. Neumann had absolute control, engaged in numerous self-dealing transactions, and promoted a culture of excess. The company was burning through cash at an unsustainable rate. But the story was just too good to question. Anyone who did was accused of not understanding the vision. The story stock investor becomes a member of a cult. Their investment is an article of faith. They ignore the red flags logged in the red flag repository because those facts conflict with the beautiful narrative they've bought into. They are investing in a dream, not a business. And when the dream collides with financial reality, as it did spectacularly with WeWork's failed IPO, the story evaporates, and so does their capital. This is the ultimate danger of being seduced by a rising price and a charismatic leader. You stop being an investor and start being a fan, and the stock market is a brutal place for fans. The direct financial connection here is the violent and sudden destruction of intangible value. On a company's balance sheet, there is an item called goodwill. This represents the intangible assets of a company, its brand reputation, its customer relationships, and so on. In a market mania, the collective belief in a story creates a kind of unofficial, off-balance sheet goodwill. The market assigns billions of dollars in value, not to the company's tangible assets or its current earnings, but to the hope and hype surrounding its future. This is what inflates a company's price-to-earnings ratio to absurd levels. The problem is that this type of goodwill is incredibly fragile. It is built on narrative, not reality. When a scandal breaks, when a charismatic CEO is exposed as a fraud, or when the business model is revealed to be unsustainable, that narrative shatters. And the market capitalization that was built upon it vanishes almost overnight. We are not talking about a 10 or 20% correction. We are talking about a 90%, 95%, or even a 100% loss of capital. The stock chart that looked like a beautiful mountain suddenly becomes a terrifying cliff. For the investor who is seduced by that rising line, the financial consequence is catastrophic. It can wipe out years, or even decades, of patient saving and investing. It demonstrates the most critical lesson in portfolio protection. A rising stock price can be the most dangerous trap in the market, luring you into a false sense of security while hiding the fatal flaws in leadership that will inevitably lead to its demise. We've established the why, the primacy of integrity, and the when, the danger of ignoring it during a market frenzy. Now, we must build the how. This brings us to our third pillar, the practical application of Buffett's core idea. This is the newspaper test in action, a practical framework for due diligence. It's not enough to simply agree with the principle. We must translate it into a concrete set of actions. How do you, as an individual investor, sitting at your kitchen table, actually perform a robust character assessment on a CEO you will likely never meet? It requires a shift in mindset, from a passive consumer of information to an active financial detective. You must learn to read between the lines, to scrutinize public records, and to piece together a mosaic of a leader's character from the clues they leave behind. One of the most telling anecdotes from Warren Buffett's career that illustrates this principle in its purest form is his acquisition of the Nebraska Furniture Mart in 1983. This wasn't a multi-billion-dollar deal for a publicly traded giant. It was the purchase of a family-owned business in Omaha. The company was founded and run by a Russian immigrant named Rose Blumkin, universally known as Mrs. B. She was a local legend, a woman who had built a retail empire from nothing through relentless hard work and an ironclad commitment to her motto, "Sell cheap and tell the truth." Buffett had watched her operate for decades. He saw how she treated her customers, how she managed her inventory, and how she lived her life. He saw a person of absolute, unimpeachable integrity. One day he went to see her and in his own words said, "Mrs. B, we'd like to buy your business." He didn't ask for a team of investment bankers to perform weeks of due diligence. He didn't hire a legion of accountants to audit her books. He wrote her a check for nearly $60 million based on a simple one-page agreement and his profound trust in her character. When Charlie Munger later asked him why he didn't get audited financials, Buffett replied that Mrs. B was a person who would rather wrestle a grizzly bear than cheat a customer or a partner. He knew with absolute certainty that she wouldn't lie to him about the business's financials. Her character was the due diligence. This story is extreme and not a model for most investments, but it reveals the core truth. When you find a leader of extraordinary integrity, you have eliminated the single greatest risk in business, the risk of being cheated, the risk of deception. The rest of the analysis, the market position, the growth prospects, becomes exponentially simpler because you can trust the information you are given. The newspaper test is our tool for trying to find our own Mrs. B's in the vast, often impersonal world of the public stock market. We are searching for that same signal of trustworthiness and rational stewardship. To apply this test systematically, we must be aware of the psychological bias it is designed to overcome, the halo effect. The halo effect is a cognitive bias where our overall impression of a person influences our feelings and thoughts about their specific traits. For example, if a CEO is charismatic, articulate, and associated with a soaring stock price, we tend to subconsciously assume they are also honest, intelligent, and a brilliant capital allocator. This positive halo can blind us to contradictory evidence. We see them on television, we like their confidence, and we automatically grant them our trust without verifying it. The newspaper test is a powerful de-biasing technique because it forces us to isolate a specific action from the leader's overall charismatic persona. It asks you to take one decision, one action, or one statement and place it under the harsh, objective light of public scrutiny. Forget for a moment that the stock is up 200%. Let's look at the specific related party transaction, where the company is leasing a building from the CEO's brother-in-law at above-market rates. Would I be proud of that action if it were on the front page of the Wall Street Journal? This act of isolation breaks the halo effect. It forces you to evaluate the action on its own merits, separate from the seductive glow of the rising stock price or the CEO's charm. It is a tool for imposing objectivity on an inherently emotional process. Now for the blueprint, the step-by-step guide to conducting this qualitative scrutiny. Let's call it the Qualitative Scrutiny Playbook. This is your action plan for implementing the newspaper test. Step 1. Become a shareholder letter historian. As we've mentioned, your first stop is the company's investor relations website. Download and read the annual letters to shareholders for the past 10 years. This is your primary source document. You are looking for several things. Consistency. Is the strategy consistent over time, or does it change with every new market fad? Candor. Does the CEO openly admit to mistakes and poor decisions, or is every year a record-breaking success with no mention of setbacks? Clarity. Is the letter written in plain English that a reasonably intelligent person can understand, or is it a fog of corporate jargon designed to confuse and impress? A manager who cannot write clearly probably cannot think clearly. A decade of these letters will give you a better sense of a CEO's mind and character than any television interview. Step 2. Analyze the unscripted moments. The shareholder letter is a prepared document. You also need to see how management thinks on its feet. This means reading the transcripts of quarterly earnings conference calls. Pay close attention to the question and answer session with Wall Street analysts. How does the CEO respond to tough, skeptical questions? Are they direct and respectful, even when challenged? Or do they become evasive, defensive, or dismissive? A leader who gets angry when questioned about their numbers is hiding something. A leader who can calmly and rationally explain their decisions, even unpopular ones, is demonstrating confidence and transparency. These unscripted moments are where the mask can slip. Step 3. Follow the money. Part 1. Compensation. Download the company's annual proxy statement, Form DEF 14A. Find the section on executive compensation. This document, while often dense, is a goldmine. You must determine if the leadership is being paid to create long-term value for you, the shareholder, or to simply pump up the stock price in the short term. Look for bonuses tied to metrics like return on equity, growth in intrinsic value per share, or other measures of true business performance over a multi-year period. Be highly suspicious of compensation plans based heavily on hitting quarterly EPS targets or simply on the stock price itself, as this incentivizes short-term gamesmanship. Step 4. Follow the money. Part 2. Insider transactions. Use a financial data service to track the buying and selling of company stock by its own executives and directors. Consistent, pattern selling by multiple insiders, especially when the stock is at a high, is one of the loudest warning signals in the market. Their actions are speaking far louder than their words. Conversely, significant open market purchases by insiders with their own money is a powerful vote of confidence. They are aligning their personal net worth with yours. Step 5. Hunt for conflicts of interest. Carefully read the related party transactions section in the company's annual report, 10-K. This is where the company must disclose any business dealings with its executives, directors, or their family members. Is the company hiring the CEO's son's consulting firm? Is it sourcing materials from a company owned by a board member? While not always illegal, these transactions create massive conflicts of interest and are often a sign of a leadership team that views the company as their personal piggy bank. This is a direct failure of the newspaper test. No one would be proud to read about such self-dealing on the front page. Following this 5-step playbook is a rigorous exercise in due diligence. It takes time and effort, but it is precisely this work that separates professional capital allocators from amateur speculators. The antithesis to this deep qualitative work is the quantitative-only investor. This is the individual who believes that all truth can be found in a spreadsheet. They build complex stock screeners, searching for companies with low PE ratios, high dividend yields, and specific debt-to-equity levels. They believe they can find undervalued gems by analyzing the numbers alone. The problem with this approach is that it is utterly blind to the most critical variable, the quality and character of the people generating those numbers. A company might look cheap on paper, but it could be cheap for a very good reason. It could be run by a management team that is about to make a disastrous acquisition, or one that has been cooking the books for years. The numbers only tell you where a company has been. They tell you very little about where it is going. The direction is determined by the capital allocation decisions made by management. The quantitative-only investor is like a person who buys a used car based solely on its mileage and paint job, without ever looking under the hood or checking the maintenance records. They are blissfully unaware of the cracked engine block or the faulty transmission. They will inevitably be blindsided by a corporate scandal, an SEC investigation, or a sudden bankruptcy that was completely invisible in their spreadsheet, but would have been glaringly obvious to anyone who had performed the qualitative scrutiny playbook. This is the path of the retail investor who consistently buys value traps, stocks that look cheap but are actually on a path to zero. The direct financial connection of this playbook is the concept of quality of earnings. This is a crucial idea in advanced stock analysis. Two companies can report the exact same earnings per share, say $1. For the quantitative-only investor, they look identical, but the investor who has done their qualitative due diligence knows they can be vastly different. Company A, run by a trustworthy management team, achieved its dollar of earnings through operational excellence, increasing sales, improving efficiency, and launching successful new products. Its earnings are high quality, sustainable, and likely to grow. Company B, run by a promotional, short-term focused CEO, also reported $1 of earnings, but they got there by cutting their R&D budget to zero, selling a factory for a one-time gain, and changing their accounting assumptions to pull future revenue into the current quarter. Their earnings are low quality, unsustainable, and likely to be much lower in the future. The newspaper test and the scrutiny playbook are your tools for distinguishing high-quality earnings from low-quality, manufactured ones. This ability is a superpower in the investment world. It allows you to invest in businesses whose financial success is real and durable, protecting you from the inevitable collapse of companies whose profits are built on a foundation of sand. It is the core of a successful strategy for long-term investing. We have now built a practical framework for identifying good character, but to truly appreciate its importance, we must stare into the abyss. We must examine what happens when this principle is ignored on a grand scale. This leads us to our fourth pillar, a cautionary tale of epic proportions: the inevitable reckoning, the anatomy of a management-led collapse. It is one thing to talk about red flags in theory. It is another to see the real-world consequences when they are ignored by thousands of investors. A management-led collapse is not like a market crash, which is often temporary. It is a permanent and total destruction of shareholder capital. It is a financial black hole from which there is no recovery. By dissecting one of these events, we can burn the pattern of failure into our minds, so we are better equipped to recognize it in the future. This isn't just about avoiding fraud. It's about understanding the anatomy of corporate suicide. While Warren Buffett's career is defined by the companies he bought, he is equally defined by the ones he avoided. One of the most spectacular blow-ups of the 21st century, a company that represented the polar opposite of his philosophy, was Valeant Pharmaceuticals. For a time, Valeant was the darling of Wall Street, a hedge fund hotel that seemingly could do no wrong. Its CEO, Michael Pearson, was hailed as a genius. The stock, which traded around $15 in 2010, rocketed to over $260 by mid-2015. The story was intoxicating. Pearson's strategy was simple and brutal: acquire other drug companies, fire most of their research and development staff, and then jack up the prices of their drugs, sometimes by thousands of %. This wasn't a business built on innovation. It was a business built on financial engineering and price gouging, and for a while, it worked spectacularly. The rising stock price created a powerful halo effect around Pearson. He was seen as a brilliant, unsentimental capital allocator. But let's apply the newspaper test. Would you be proud to see the headline, "My company increased the price of a life-saving heart drug by 500% after acquiring it," on the front page of your local paper? Would you want to explain that business model to your children? The answer for any person with a functioning moral compass is a resounding no. This was the first and most glaring failure. The company's entire business model was ethically questionable and relied on practices that were destined to attract negative attention from politicians and regulators. The red flags, however, didn't stop there. An investor applying our qualitative scrutiny playbook would have found a mountain of them. The company's financial statements were a nightmare of complexity, relying heavily on adjusted earnings that ignored massive real costs. They funded their acquisition spree with enormous amounts of debt, creating a fragile balance sheet. And most damningly, they had a secret, undisclosed relationship with a specialty pharmacy called Philidor, which was using questionable tactics to push Valeant's high-priced drugs onto patients and insurers. The information was out there for any diligent investor to find. But the stock was going up. The story was too good. The herd was stampeding, and no one wanted to be left behind. Then came the inevitable reckoning. In 2015, the story began to unravel. Scrutiny from politicians over its price gouging intensified. Short sellers published detailed reports exposing the secret relationship with Philidor. The SEC launched an investigation. Suddenly, the narrative shattered. The market realized that Valiant's earnings were not the high-quality result of operational excellence, but the low-quality result of accounting tricks and predatory practices. Trust evaporated overnight. The stock began to fall, then it plunged, then it went into freefall. From its peak of over $260, it would eventually crash to below $10, a more than 96% destruction of shareholder wealth. Michael Pearson, once hailed as a genius, was fired in disgrace. The company was buried under a mountain of debt it could no longer service. Tens of billions of dollars in market value simply ceased to exist. The Valiant saga is the perfect case study in a management-led collapse. The warning signs were not hidden. They were in plain sight for years, but they were willfully ignored by investors who were seduced by a rising stock price and a charismatic CEO, a classic failure of portfolio protection. This type of corporate self-destruction is often driven by a toxic cocktail of psychological biases at the executive level, primarily overconfidence bias and an unchecked CEO ego. A leader like Michael Pearson, after a string of successful acquisitions and a soaring stock price, can begin to believe their own hype. They develop a God complex, a feeling of invincibility. They start to believe that the normal rules of business and ethics don't apply to them. This overconfidence leads to excessive risk-taking. They take on more debt, they pursue ever larger and more reckless acquisitions, and they cut corners on compliance and ethics because they believe they are too smart to get caught. For the investors watching this happen, a different bias takes hold: the boiling frog syndrome. The ethical compromises and accounting shenanigans don't happen all at once. They happen gradually, one quarter at a time. The first time the company uses a questionable accounting trick, investors might be concerned, but the stock goes up, and they get used to it. The next quarter, the trick is a little more aggressive. But again, the stock performs well. Like a frog in a pot of slowly warming water, the investors acclimate to the rising temperature of risk. They become desensitized to the red flags. By the time the water is boiling and the scandal erupts, it's too late to jump out. This gradual erosion of standards is how investors get trapped in these value-destroying companies. To immunize yourself against this fate, you must proactively study failure. The blueprint here is the post-mortem analysis model. Your task is to become a student of major corporate collapses. Choose a famous flameout, Enron, WorldCom, Wirecard, or Valiant, and conduct your own investigation. Build a timeline of events. Go back 5, 7, even 10 years before the final collapse. Read the old annual reports, the analyst commentary, and the news articles from that time. Your goal is to identify the exact point in time when the first clear red flags of poor corporate governance or questionable character became visible to the public. You will almost always find that the seeds of destruction were sown years before the company's demise. For Enron, it was the shift to opaque off-balance sheet accounting. For WorldCom, it was the aggressive acquisition strategy fueled by accounting fraud. By working backward from the disaster, you can train your brain to recognize these patterns in the present. This exercise transforms you from a reactive investor who is surprised by a collapse into a proactive risk manager who sees it coming from a mile away. It is an essential practice for anyone serious about capital preservation and avoiding the catastrophic losses that can derail a lifetime of financial planning. The antithesis to this disciplined study of failure is the most dangerous phrase in investing: this time it's different. This is the mantra of the investor who sees the red flags but chooses to ignore them. They perform the due diligence, they see the aggressive accounting, they note the CEO's arrogance, they recognize the pattern from past blow-ups, but then they engage in a bout of special pleading. Yes, they tell themselves, the accounting is aggressive, but this company is a true disruptor, and they need to move fast. Or, sure, the CEO is overly promotional, but he's a visionary, and that's what it takes to change the world. They convince themselves that this particular company is a special exception to the timeless rules of business and finance. Hope replaces analysis. The desire for the story to be true overrides the objective evidence that it is not. This is not investing, it is faith. And while faith can move mountains, it is a poor foundation for a wealth management strategy. The laws of financial gravity are unforgiving. Companies that rely on debt-fueled acquisitions, opaque accounting, and unethical practices will eventually come crashing down to earth. The belief that this time it's different is the final, fatal symptom of an investor who has been completely seduced by the narrative and has abandoned all principles of sound stock analysis. The direct financial connection of a management-led collapse is the utter and permanent destruction of shareholder equity. Let's be clear, this is not a cyclical downturn or a market correction. When a company like Valeant or Enron collapses, the equity on the balance sheet is wiped out. Let's visualize it. Before the fall, Valeant had a balance sheet with billions of dollars in goodwill from all the companies it had overpaid for. It also had a crushing mountain of debt. When the scandal hit and the company's earnings power was revealed to be a mirage, two things happened. First, the company had to take massive write-downs, acknowledging that the goodwill was worthless. Billions of dollars in assets simply vanished from the balance sheet. Second, the company's ability to generate cash to pay its debts disappeared. The value of the company's assets was now less than the value of its liabilities. This is the definition of insolvency. For the common shareholder, this means their claim on the company's assets is worthless. The bondholders and other creditors are first in line, and by the time they are done picking over the corporate carcass, there is nothing left for the owners. This is the ultimate negative financial outcome. It underscores why the newspaper test is not just about making money. It's about not losing money in the most catastrophic way possible. It is the ultimate tool for avoiding the financial black holes that can swallow your entire portfolio. We've explored the foundation, the psychological traps, the practical tools, and the dire consequences of failure. But the newspaper test is not merely a defensive strategy. It's not just about avoiding the Valeants of the world. It is also a powerful tool for identifying the greatest wealth-creating enterprises. This brings us to our fifth and final pillar, the compounding of trust, the long-term financial power of ethical stewardship. When you find a company run by leaders with both integrity and talent, you have found something far more valuable than a cheap stock. You have found a compounding machine. Trust itself becomes a key ingredient in the business model, creating a virtuous cycle that generates enormous, sustainable value over decades. This is the ultimate prize for the discerning investor, the financial transformation that comes from partnering with the best. To see this principle in its full, glorious action, we look to one of Buffett's most successful investments of all time, the Coca-Cola Company. In 1988, Berkshire Hathaway began accumulating a massive stake in Coke, eventually investing over $1 billion, which at the time represented a huge portion of Berkshire's net worth. Many on Wall Street were skeptical. Coke was already a mature, giant company. How much bigger could it get? But Buffett wasn't just investing in the brand's sugary water. He was investing in its leader, Roberto Goizueta. Goizueta, who had become CEO in 1981, was a man whose mindset was perfectly aligned with Buffett's. He was a brilliant, rational capital allocator who was fanatically focused on one thing: increasing the long-term economic value of the business for its owners. Before Goizueta, Coke's management had been somewhat complacent, diversifying into unrelated businesses like shrimp farming and motion pictures. Goizueta immediately put a stop to that. He sold off the non-core assets and focused every ounce of the company's energy and capital on strengthening its global beverage dominance. More importantly, he fundamentally changed how the company measured success. He championed the concept of, quote, economic value added, or EVA, which meant that any investment had to earn a return greater than the company's cost of capital. This sounds simple, but it was revolutionary at the time. It instilled a deep discipline of ownership and rational decision-making throughout the entire organization. Goizueta's actions would have passed the newspaper test with flying colors day after day. He was transparent with shareholders, he was honest about challenges, and his every move was calculated to create real, durable value. Buffett saw in Goizueta not just a hired manager, but a true partner. He trusted him implicitly to be a wise steward of his capital. And that trust was rewarded beyond anyone's wildest imagination. Over the next decade, Goizueta's leadership transformed Coca-Cola into one of the most profitable and dominant companies on the planet. The stock soared, generating billions upon billions of dollars in gains for Berkshire Hathaway. The Coca-Cola story is the perfect positive example. Buffett used his character filter to identify an exceptional leader, made a massive bet, and then let that leader's ethical stewardship work its compounding magic for years. This is the offensive power of the newspaper test. It helps you find the rare combination of integrity and talent that creates legendary long-term returns. The incredible success of companies led by great stewards can be explained by a powerful mental model from Charlie Munger, the Lollapalooza effect. This is what happens when several psychological principles and business advantages all act in the same direction, not just adding up, but multiplying and creating a powerful, non-linear outcome. A company with trustworthy, rational, and ethical leadership benefits from a positive Lollapalooza effect. First, you get superior capital allocation. As we saw with Goizueta, there are no ego-driven bet-the-farm acquisitions. Every dollar of profit is reinvested with discipline and a focus on long-term returns. This alone leads to better-than-average financial results. Second, these companies become talent magnets. The most talented and ethical people want to work for leaders they respect and admire. They want to be part of a winning, high-integrity culture. This creates a huge competitive advantage in attracting and retaining the best employees, which drives innovation and efficiency. Third, you gain incredible customer and brand loyalty. Customers instinctively trust brands that are run by honest people. This trust creates pricing power and repeat business. Think of a company like Costco. Its commitment to providing value to its members is absolute, and its customers reward it with ferocious loyalty. Fourth, you earn shareholder patience. When a company with a long track record of integrity and smart decision-making hits a rough patch, its long-term shareholders don't panic and sell. They give management the benefit of the doubt. This stability allows the company to make smart long-term decisions without worrying about short-term market reactions. When all these forces, rational capital allocation, talent attraction, customer loyalty, and shareholder patience are working together, they create an almost unstoppable momentum. This is the compounding of trust, a Lollapalooza effect that generates extraordinary returns for entrepreneurs and investors who get on board. How can you, as an investor, ensure you are only partnering with these kinds of leaders? You need to adopt a new mental model for your investment decisions. Let's call it the Partnership Mindset Protocol. This is a final, simple, but incredibly powerful filter. Before you buy a single share of any company, you must ask yourself one question. Am I willing to have this CEO and this management team manage my family's entire net worth with no ability to sell for the next 10 years? Think about the gravity of that question. It immediately elevates the stakes. You are no longer just picking a stock. You are choosing a business partner to whom you will entrust your financial future. If your answer is anything less than an immediate, unhesitating, and enthusiastic yes, then you must not invest. This protocol forces you to move beyond the superficial analysis of stock charts and quarterly earnings. It demands that you have a deep and abiding trust in the character, competence, and integrity of the leadership team. It forces you to think like an owner, not a speculator. Adopting this mindset is the final step in internalizing the newspaper test. It makes the decision personal. It's no longer about abstract companies. It's about the people you are choosing to go into business with. This CEO mindset is the ultimate key to a successful long-term investing strategy. The antithesis of the partnership mindset is the day trader or the speculator. This individual inhabits a completely different mental universe. For them, Stocks are not ownership stakes in real businesses run by real people. They are just flickering symbols on a screen, blips on a chart to be bought and sold for a quick profit. The speculator has no idea who the CEO is. They have never read a shareholder letter. They couldn't tell you the first thing about the company's culture or its capital allocation strategy. They are playing a game of patterns and momentum, a high-stakes guessing game on short-term price movements. Because they have done zero due diligence on the most important factor, management, they are exquisitely vulnerable. They are guaranteed to be the ones left holding the bag when a company like Valiant or Enron implodes. The scandal will come as a complete shock to them because they never bothered to look at the people in charge. They are the prey that the corporate predators of the market feed on. They may have a few winning streaks, but over the long run, their approach is a mathematically proven path to ruin. They are mistaking gambling for investing, and the house always wins in the end. The ultimate financial connection, the final proof of this strategy's power, is found in the one metric that matters above all others for a long-term investor: the sustained, multi-decade growth in a company's per-share intrinsic value. Intrinsic value is the true underlying value of a business based on the cash it can generate over its lifetime. Companies run by exceptional stewards of capital, the ones who pass the newspaper test and the partnership protocol with flying colors, have an almost magical ability to grow their intrinsic value per share at a rate that consistently outpaces the market averages. Look at the long-term charts of companies known for their strong, ethical cultures and rational management. Companies like Berkshire Hathaway itself, or Costco, or Markel. You will see a relentless, upward march in value. This is not luck. It is the direct, tangible financial result of thousands of smart, disciplined, and ethical decisions made over a period of many years. It is the mathematical expression of compounded trust. This is how true, lasting wealth is built. It is not through frantic trading or chasing hot tips. It is through the simple, powerful act of partnering with honorable and talented people, and then patiently allowing them to work their magic. This is the financial freedom that comes not from a lucky bet, but from a wise choice of partners. It is the final promise of the newspaper test. You have just spent this time absorbing a complete framework, not just a tip or a trick, but a fundamental pillar of Warren Buffett's operating system for avoiding catastrophic risk and compounding capital. You now possess the newspaper test, a mental tool that can serve as your guardian in the often treacherous world of the stock market. You understand the primacy of integrity. You've seen the psychological traps that cause others to fail. You have a practical playbook for due diligence. You've witnessed the anatomy of a collapse, and you've seen the immense financial power of compounding trust. This knowledge elevates you. It separates you from the 99% who are driven by greed and fear, chasing headlines and hype. You now have a powerful defensive strategy, a way to protect your capital from the hidden predator of flawed character. But it is crucial to understand that this is only one piece of a much larger puzzle. Buffett's incredible success is not the result of a single mental model, but a complex, interlocking architecture of them. The newspaper test for management is one critical pillar, but it is supported by other, equally powerful pillars governing valuation, competitive advantage, and market psychology. Mastering one gives you protection. Mastering the entire system gives you power. The journey to becoming a truly sophisticated capital allocator, to achieving real and lasting financial freedom, requires the assembly of this complete mental arsenal. You have laid a crucial foundation, but the structure is not yet complete. The video that is now appearing on your screen is not a random suggestion. It is the next piece of the map. It is the missing link that connects the principle of management integrity to the next core concept in the Buffett-Munger approach to wealth. It is the blueprint for another essential pillar in that fortress of financial reason. The average person, the speculator, the gambler, their journey ends here. They have a single tool, and they think they're finished. But for those who are serious, for those who see investing not as a game but as the art of business ownership, the journey is just beginning. The decision to click is not about watching another video. It is a statement about who you are. It is a commitment to continue your ascent, to complete your toolkit. and to master the interconnected system of thought that has created more wealth than any other in history. The choice is yours. Complete the map.